The change in the role of trustees in relation to investments has transformed in the last 10 or 15 years. In the old days, mostly trustees didn't make big policy decisions on investments. They took their advice from their investment consultant or their actuary, and he decided what kind of investment spread he thought was fair and reasonable in the circumstances.
In my 30-odd years in pensions, the role of a trustee has changed. In my early days, trusteeship really was all about human resource, personnel type issues, who gets an ill health pension, which dependent gets the death benefit. Nowadays it's increasingly financial in nature, but financial in terms of making sure there's enough money in the pot.
Trustees' responsibilities and roles have changed very materially in the last 5 or 10 years. I think 10 years ago, when schemes were growing and were immature, it was all about keeping a supervisory eye on long-term investment. Now it's much more focused on risk management. The time horizon for schemes is shorter. Most of them are closed to new entry, some to new accrual, so you're talking about shorter time horizons. There's more regulation, there's more focus on delivering returns in what is sort of a 5 to 10 year period and controlling risk over shorter periods than that. So there has been a big change. So the whole focus has switched from looking at return-seeking assets to thinking about managing risk.
It's very disappointing. In the last couple of decades, we've gone from a long-term view of investments to a very short-term, almost quarterly look, where nothing seems to matter except risk reduction and minimisation of changes in market value. And that's very disappointing if you're trying to fund a long-term pension scheme where you should be able to benefit from the absence of a need to sell investments in the short term, and therefore market values don't matter that much.
I think the whole issue of time horizon is enormously complicated for trustees because they actually have a whole variety of time horizons that they need to think about. So they've got a 60 or 70 year time horizon, and they could probably sit back and say we can invest in risky assets across that period, and in all probability everything will work out reasonably well. However, no one can take a bet on quality of corporate covenant over a 60 or 70 year period, and if the covenant were to fail at the point in that cycle when the asset value was significantly reduced, then that means that you'll be paying benefits, perhaps only half of what you intended to pay.
The pension fund portfolios in the 1920s and 1930s were almost 100% in either government securities or in mortgages on property. And because of the ravages of inflation towards the end of the 20s and really much and at the beginning of the 1950s and 1960s, pretty much destroyed the value of pension schemes. And the cult of the equity, which was developed in the 1960s really, said that what we should really be investing in, and even though it's risky and even though it's volatile, is equities, because equities reflect inflation, they reflect the development of a capitalist economy, and by and large that will protect members' interests much better than gilts will do. And that belief has existed until fairly recently. And it's only really the recent legislative requirements and the accounting requirements that have made people switch more into gilts, and we may find that, with hindsight, to be a mistake.
Over the past 10 or 15 years, then average allocations to equities across UK pension schemes have probably dropped from 60% towards 40%, so very significant fall. And there's a one-word reason for that, which is risk. So the risk involved in investing in equities is more openly acknowledged and factored into trustee and corporate decision making, and a single bet, which is what many UK pension schemes used to run, which is a single bet on the equity risk premium, is now seen as being too risky a proposition for the future delivery of benefits. So hence there's a diversification away from that single bet risk.
Interestingly, as markets have fallen back, so the opportunity to make long-term positive returns from equities has necessarily increased. Therefore, I would argue that this is not a good moment for long-term investors to consider selling equities. But the decision to sell equities is now much more risk-driven than return-driven.
It's still, of course, seen by most commentators as a long-term bet that is likely to pay off. But what one means by long-term is really very important in that, because we've had a 15-year period when there's been no equity risk premium, and most people's idea of what is long term would probably have been a bit less than 15 years.
Well, very, very simply, it's that companies now have to report the size of pension deficits on their balance sheets and the effect that has through their profit and loss accounts. So again, a few years ago that didn't have to happen. So there's been it's gone up the company, the finance director's agenda a long way. So it's now a big item for the finance director is how big is the pension deficit, how can he control it. He doesn't want a random big number coming onto his balance sheet just because of what's happened in the pension scheme when he's trying to run the business in another way.
Accounting is a massive issue because we have this FRS 17 accounting standard and it is widely misunderstood by trustees. I've been to many trustee meetings where they assume that the FRS 17 figure represents their liabilities, and of course it does not. It's a completely artificial figure which is arrived at for the financial accounting purposes of the sponsor. It's nothing to do with the pension fund at all, and no accountant in the world pretends that it gives a true and accurate figure of the real liabilities of the pension fund. And the one thing pension trustees have to get away from is this obsession with trying to manage the FRS 17 figure rather than managing their assets.
Well, I agree with the idea that FRS 17 is more of an issue for the finance director than for the trustees. I don't think trustees should be worrying about an accounting measure of what the pension deficit is. They will have lots of other measures of value of liabilities and of their assets. But I do think it has brought attention to the nature of the liabilities that a pension fund has. And liability-driven investment is trying to deal with some of those issues. And I think trustees have bought into the idea that taking interest rate risk over the long term is a risk which, on the whole, you don't get a reward for. So if you can put in place a policy which removes that risk as far as you can, then you're taking away something which can seriously affect the value of your assets against your liabilities.
And I think you've got sort of two potentially opposing forces. You've got the trustees who are trying to invest for the long term, to generate return, to be fully funded over a long period of time, make sure there's enough money in the pot to pay the pensioners. And then you've got the company who is focused on not having too big a deficit in any one year and not too much variability in that deficit. And in a sense, because one is trying to reduce risk, which tends to mean it's got to reduce return, and the other is trying to generate return and not be so focused on short-term risk, there can be a tension between these two.
The big problem is this short-term accountability that we see in every facet of life nowadays, but it's permeated through to pension schemes where perhaps it shouldn't have done in quite the way it has done.
The fad that frightens me most, and I think it is a fad, is a belief that you can drive every risk out of every pension scheme. The credit crunch should remind us that risk is a fact of life, and rather than use our credit crunch experience to discover more and more risks and to try and protect ourselves against them, we have to recognise that getting out of bed in the morning is a risky business, but it'd be a rather dull world if none of us got out of bed